Okay, this is again a sum of merger. Sole trader plus sole trader. May-June 2019, paper 31. Can someone read the question for me, please? Arij, read.
Jenny and Thomas are two sole traders. Their statement of financial position at 31 March 2019 were as follows. They agreed to merge their two businesses into a partnership with effect from 1st April 2019. The terms of the merger were as follows.
Okay,
The value of
just stop, okay? If you see over here, I can clearly see I have been asked to prepare what?
Capital account.
I have been asked to prepare a capital account. I can clearly see that, right? So when I am reading the question, I can pick up the details that is related to capital account and I can put it over here. So what are the details that is related to capital account? You can see
The balance.
the balances. Where will it be put? Can you tell me?
Credit side.
On the credit side. So I will put the balance begin down for Jenny and I will put the balance begin down for Thomas. Are you all doing it along with me?
Yes, miss.
Yes.
So it is 170,000 for Jenny and it is 100,000 for Thomas. With me?
Yes,
Yeah.
miss.
Okay. Now this is the terms of the merger. So understand one thing, this is understood that if they ask you to prepare a capital account, they would either give you profit or loss on revaluation, additional capital, or adjustment of the capital as per the new profit sharing ratio. So only these three things could come, that is profit or loss on revaluation, additional capital, adjustment of closing capital as per a new profit sharing ratio, and one more thing could come in is goodwill adjustments. Other than this, you will not find any adjustments that could be done in the partner's capital account, not 3, 4. With me?
Yes, miss.
So when you're reading, try to incorporate as much as you can so that you don't waste time, because every sum is given not more than 30 minutes. Now read ahead, come on.
The value of the non-current assets of both sole traders had increased by 10%.
Come on, tell me, what does this mean?
To increase non-current assets by 10% of
You
Jenny
will
and Thomas.
increase the non-current assets by 10%. What does that mean?
Evaluation amount is credited by the
There
increase.
is a revaluation gain of how much? 10%. So 10% of 15,000 is 150,000 would be 15,000. And for 90,000, it would be how much?
9,000.
Plus 9,000. Come on, revaluation gain would go on which side?
Credit.
On the credit side. So I will write non-current assets 15,000 and I will write the non-current assets 9,000. What will I write in bracket? If you want, you can write, otherwise it's fine.
Miss, can you just like in rough working, just prepare the reval account and then at the end you write the
You
reval.
can prepare a revaluation account, but see, in the above sum we did, we prepared it individually. So unless and until it is not as you can do individual adjustments, it does not really make a difference.
Okay, fine.
Okay. Come on, let's go ahead.
Inventory was valued at 27,000 for Jenny and 10,000 for Thomas.
27,000 for Jenny and how much for Thomas?
10,000.
Tell me, what is it? For Jenny, it is what, gain or loss?
For Jenny, it's a loss.
It
Loss.
is a loss.
Thomas,
Which side will I write?
500 on the debit side.
And for Thomas, it is
That's also a loss.
that is also a loss of how much?
1,000
1,000.
debit.
So what will I write?
Inventory bracket revaluation loss.
That bracket thing, if you want, you write. There is no compulsion. Simultaneously, I'm doing it on the question also so that I don't have to go back. I know that whatever adjustment I'm picking up, I am completing the effect of it. Are you with me?
Yes, miss.
Come on. Next,
Both sole traders expected 5% of their trade receivables to be written off.
is it a good thing or a bad thing?
Bad.
It will go in the capital account. Which side?
Debit.
What will you write?
Bad
Trade
debts.
receivables.
Oh, okay.
You can write, yeah, you can write bad debts also, not a problem, but I will write trade receivables. 5%. So 17,500 into 5% is 875. And this would be 6,500 into 5% is 325. I will minus and I will get the answer also. So this will be 16,625. And this will be 6,175. Are you with me?
Yes, miss.
Miss.
Other things except cash and cash equivalent were transferred to the partnership at the book value. Okay. Are you with me?
Yes, miss.
Yes.
Okay, fine. Now what will you do? Come on, tell me.
The cash amount.
Prepare revised capital account to show the amount that is transferred to the partnership. That means they've asked us to find out what? Closing capital. What have they asked us to find out? The revised capital account that is to be transferred to the partnership. So they have asked
Plus,
us to find what? Closing capital. Yeah, tell me.
cash won't come in the capital account.
Sorry.
Cash.
Cash what?
The cash and cash equivalents that both of them have.
It is to
That
be
won't come.
transferred. Listen to me. All the other assets and liabilities except cash and cash equivalent. Okay, cash and cash equivalent
Yeah,
is
that's
okay. Cash and cash
the
equivalent is
step.
not
Right.
going to the partnership. Thank you, Sidra.
Hmm.
Cash and cash equivalent is not going to the new partnership. If it is not going to the new partnership, it means that the partners will take it away. If the partners will take it away means what? It is
Credit.
partners' drawings. Since cash and cash equivalent is not going to the new partnership, it means that the partners are going to take it away. It is not going to go to the new statement of financial position. If the partners are going to take it away, it becomes their drawings. Drawings comes on which side?
Debit.
Drawings will come on the debit side. So they are going to take away the cash and cash equivalent. How much amount? For Jenny, it is 9750. And for Thomas, it is 3750. See, if the cash and cash equivalent were taken by the new partnership firm, when they are merged, then I will write it in the statement of financial position. But they are specifically telling us that except cash and cash equivalent, everything else is going away. So this will be taken away as drawings. Now we can close our capital account and find the closing balance that will be transferred to the new partnership. Come on, close the capital account.
$173,875 for Jenny.
Can you give me the total also?
$185,000.
185,000. And over here, for Thomas, is it 103,925?
Yeah.
So it is 103,925. Now what am I asked to prepare? I'm asked to prepare the opening statement of financial position. Before that, there is one more thing. I want you to take some time and read that one more thing that they've asked us in B. Read it yourself. I'm giving you 2 minutes time to think on what is it.
Miss, is it the same adjustment we did in the previous?
Yeah, it is the same adjustment as we did in the previous. Like what? Tell me.
The closing balance would be 360,000 in that ratio.
The total opening capital was how much? The total opening capital for the new partnership, they wanted how much? 360,000. Right? What are they telling? That they want that the new partnership starts with how much? Jenny and Thomas. Jenny and Thomas. So they are telling that they want the new partnership to start with 360,000. That means when you're closing the books, your closing capital for the beginning of the new partnership should be how much? 360,000. And this 360,000 should be in the ratio of 2:1. So what would be the closing capital for Jenny and Thomas? 360,000 divided by 3. So 2/3 of it would be how much? 240,000 and 120,000. And I already have their opening capital. How much is their opening capital? I have already calculated their opening capital, which is 173,875 and 103,925. Yes. I have already calculated the capital after giving effects for revaluation and what they are going to take away. I have found this. Are you all with me?
Yes,
Okay.
miss.
Yes.
Okay. And what do they want that the new partnership should start with what amount? In the profit sharing ratio of 2:1, it should be a total of 360,000. And to make this, each partner should introduce what? Cash. So calculate the amount of additional cash that each partner should introduce. So tell me the cash that Jenny will introduce. Can you tell the cash that Jenny will introduce?
Jenny will introduce 66,125
How did you find it?
to 240,000 minus the opening amount.
73,875. So how much will
Yeah,
she introduce? 66,125.
66,120.
And how much will Thomas introduce?
1 minute.
16,075.
So Thomas will introduce $16,075. Okay. Now they want you to prepare the statement of financial position for the new partnership. I have all the amounts that is given, but you have to merge it. Be careful that you merge the revalued amounts. So you need to have proper markings on your question paper. You need to have proper markings on your question paper. So could you make it? I'm keeping it over here. What will be the new cash and cash equivalent?
$82,200.
Yeah, you'll add both of this. The non-current assets would be 165,000 plus 99,000. Inventory would also be at new value, which is 27,000 plus 10,000. Trade receivables would be 16,625 plus 6,175. The cash and cash equivalent would be the new amount, that is 66,125 plus 16,075. Capital account would be the new capital of 360,000. Split in the ratio of 2:1. Trade payables, the current liabilities, there is no change in it. 4,750 plus 11,250. I hope you're understanding.
Yes, miss.
Okay, the next part of it. Partners have agreed to take equal salaries of 10,000 per annum. Residual profit is to be shared in the ratio of 2:1. When you read residual profit, what comes into your mind? When you read the word residual profit, is there anything that is coming to your mind?
After appropriation.
Okay, after appropriation. So, what is the appropriation that can happen?
The interest on capital, interest on loan and everything.
Interest on
Salary.
salaries to partners. So, they are saying that the residual profit is to be shared in the ratio of 2:1. And they are telling us that the profit before appropriation for the first year's trading will give a return of 13.5% on total opening capital balances. Can you interpret this? What will be the profit before appropriation?
13.5% of 360.
So the profit before appropriation will be 13.5% of the total opening capital balance. So what is the total opening capital balance?
240 plus 120, so 360.
360,000. So can you give me the profit before appropriation?
48,600.
To 13.5%, the profit before appropriation is 48,600. Average profit of Jenny over the last 3 years was 35,000 per annum. Okay. Calculate total share of expected profit for the first year of trading. What do they want us to find out? Jenny's expected profit for the first year of trading. Come on, tell me. Jenny is to Thomas are sharing profits in the ratio of how much? 2:1. Yes? Yes or no?
Yes.
I have been given profit before appropriation and I want to know Jenny's share. So will I try to come at the residual profit? Yes?
Yes.
So
Yes, miss.
I will deduct what? Appropriation, and I see only one appropriation, salary to partners. And it is 10,000 per annum per partner. So it will become 20,000. So is my residual profit 28,600? Yes.
Yes.
What would be Jenny's share? Jenny's share would be 28,600 into 2/3.
It would be 19,066.7.
8,066.7. So can I take it 19,067? Yeah. So Jenny will receive only profit or Jenny will also receive salary?
Salary also.
So Jenny will also receive salary of 10,000. So what is Jenny's total share of expected profit? So I will say Jenny's total share of expected profit is how much?
So,
29,067.
so we have to add Jenny's salary also.
She is going to get 19,067 as a part of the residual profit. But the salary that she is going to get, it is out of the profit before appropriation. So even that is a part of the profit, right?
Okay.
So they are telling us to find out the total share of expected profit.
Okay, miss.
Total share of expected profit. So this is Jenny's total share of expected profit. Are you with me?
Yes, miss.
Yes.
Should I proceed ahead?
Yes, miss.
Okay, fine. State one advantage and one disadvantage of forming partnership. What is the advantage of forming partnership?
Responsibilities and tasks are shared.
Responsibility is shared. There is greater capital that could be invested. There is a greater pool of knowledge. You need only one. It's 2 marks. And what is one disadvantage?
Profits are shared amongst partners.
Now you've become big, you've reached in AS. Can you use better words? Can you see over here? First, Jenny was earning how much? Can you see over here? Initially, Jenny was earning how much? 35,000 per annum. But now she is earning how much?
29,067.
So can you say that Jenny is worse off because it is resulting in less earnings than what she was earning before? I'm just giving a
Yeah.
suggestion. Otherwise, you can normally write profits will decrease over time. Come on, write 1-1, whatever you all want to write. Just tell me done when you're done.
Yeah, miss, done.
Done. Only one is done.
Done, miss.
Okay. Now, two advantages and two disadvantages of using computerized accounting system. You all have one chapter which is named computerized accounting system. So there are these few theory questions which are very popular and they keep on repeating. So computerized accounting system, it is basically a system of doing accounting on the computer. So advantages of using computerized accounting system is that it is more accurate. It gives higher efficiency. Your staff is motivated and there is a lot of speed when you do that because things happen automatically. And disadvantages that you need to train your staff. There would be hardware costs, there would be software costs. This is the most easiest one. You need two advantages and two disadvantages. You can learn and write.